Well, I think the idea of trying to define hyperinflation by attaching a number to it is actually a mistake. What we should be looking at is the current situation and how it is likely to evolve. And as we've already discussed, I think the situation in America is that you are in the early stages of a hyperinflation, unless there is a change in monetary policy sufficient to negate the inflation that we've seen so far. I see no sign of that whatsoever. I see, if anything, the government going in the opposite direction. And not only that, but all the signals we get from government is that, when things go even more wrong in the private sector, their answer is to just jump down on the private sector. They're moving away from free markets, which can be the only solution. There is also the broader question of confidence. You mentioned that word a couple of times. And this is where the monetarists actually get the relationship wrong. You can't say that because inflation, let's say M1 increased by 400% over the last 2 years, that's going to give us, a 230% annualized rate of price inflation. You can't do that because the effect of monetary inflation on prices boils down to a combination of the diluting effect of money as it enters into circulation. And that's never an even story. It's a gradual process. And also any changes in confidence that the money's users have in its purchasing power. And this is what, if you look at an extreme example, if people lose all confidence in the dollar as money, then it will be completely worthless. It doesn't matter what the quantity is. It will just be completely worthless. If, on the other hand, they think that the purchasing power of the dollar is going to go up and up and up and up, because of monetary policy, for example, or something that's stated that we want to have a higher dollar and they actually back it with some sort of actions, then what people will do is they will tend to hold on to their dollars in the expectation that there will be lower prices in future. So they defer their purchases instead of bringing them forward. And that, again, will tend to increase the purchasing power of the dollar, irrespective of any changes to its quantity. So you've got to look at both things. And confidence in the purchasing power is extremely important. You can't look at one without looking at the other. And the point about where we're going is that when people finally wake up that it's actually money going down, not prices going up, then at that stage, all hope for the dollar will be lost. Because this is what the Austrian economists call the crack-up boom. It leads into the crack-up boom, which basically is when people take every bit of cash they possibly can get their hands on and spend it before its purchasing power goes down even more. And, the tales from Germany in 1923, when, a chap would go and collect his wages from the bank, and he would do this twice a day, ends up with a barrow load of paper marks, goes into the shop and says, right, I want to buy whatever it is, and goes out to get the money and finds that the money is being dumped and the wheelbarrow stolen. That is where we will get to unless something is done about this current situation. I see no move to deal with it. And the fact that the authorities are not only ignoring it, but I think indulging in very severe groupthink on the whole thing. So dismissing any alternative explanation of the current situation out of hand tells me that things are going to have to get a lot worse. Well, I don't think that the position is being driven by the COT reports, but we keep an eye on it because really what we want to see is the amount of bullishness that might be already in the particular metal. And I was looking at the situation on gold earlier today because the report was delayed actually until yesterday. And when you look at the managed money category, which basically are the hedge funds, these are algorithmic traders and, all the rest of it, they have actually increased their position very, very sharply, which is hardly surprising because open interest since the beginning of this month has increased by over 100,000 contracts. I mean, that's a very, very big jump. So you would say on that basis that the market has suddenly become really quite overbought. Now, I mean, if we were dealing with a stock in the stock market, we would say that, it's time it had a little bit of consolidation back. We need to get it back into firmer hands before the next move can occur. But in the case of gold and silver, that's very often the right thing to do, but it's now becoming very much an event-driven situation because I find that people are beginning to wake up to this inflation threat. And then there is the next problem. The next problem will be, what are the Fed going to do when tapering begins to undermine financial assets? Bond yields start rising and equity prices start falling. I mean, from the Fed's point of view, that's not an outcome they want to see. So they will probably stop tapering quite smartly or adjust it. I think that's a good phrase, isn't it? They'll adjust their tapering. And if the stock market falls quite heavily, which I think is a very strong possibility, then the only way they can stop it is to bring back quantitative easing. And instead of doing, 125 a month or whatever, if they they'd probably have to jack it up to over 200 billion a month, to try and stabilize the market. Now, that then destroys the dollar. But then you've got foreigners holding dollars already, and about 14 trillion, I think, at the last count of that, was invested in equities. Equities start tanking. If the Fed doesn't do anything about it, the foreigners are going to sell anyway. So, I think they've got to the point where they're damned if they do and they're damned if they don't. And that, I think, is going to be the next real problem that we're all going to face. And I think there's a general sense of unease developing, which I think is beginning to be reflected in the gold price. And I don't see the rise in the gold price stopping here necessarily. I think it's too early to say that people are viewing it as not so much the gold price rising, but the purchasing power of the dollar falling. But it's not going to take an awful lot for people to begin to think that way. Mm-hmm. I think for technical traders, probably yes. The reason for pointing that out is that a golden cross is a very reliable indicator of a change in underlying trend. And in this case, the trend is of the yield on this 10-year US Treasury bond. What that is telling us is that the yield is going to go quite a lot higher. But if you marry that with what we've seen in terms of monetary inflation, I mean, it really should be no surprise. So the people who would pay attention to a golden cross aren't necessarily following the underlying developments, which are far more serious than a technical development that might support a rise in the yield to around about 3%, which is roughly what it's telling us at the moment. Mm. It's a lot more serious than that. And we're going to see yields on US debt far higher than that, I think, particularly at the short end. There may be some leveling out as you go longer and longer, because what tends to happen is that there is always an appetite amongst the pension funds and the insurance companies for long-term, high-yielding, nominal yielding government debt. So there will be some support at the long end. But what I do see is that interest rates at the short end, they will rise against the desire of the Fed. The Fed will have no option but to follow it. It won't be led by the Fed at all.